welcome to this edition of Talking Taxes. Today we are putting the spotlight on alternative investment funds, investment vehicles that meet a multitude of objectives, right from financing infrastructure and startups to trading in various markets with an eye on some smart gains. So have AIFs really taken off as intended? Is the regulatory and the tax framework conducive for their further growth in India? Well, joining me to talk about some of these issues are GAUTAM MEHRA, India tax leader at PwC, Mohandas Pai, Chairman of Manipal Global Education, and Nandita Agrawal Parker, General Partner at Karma Capital Management. It's great to have all of you on this special show. Thank you for joining in. But ladies and gentlemen, before we get started, here's just a quick lowdown on AIFs and the current standpoint. So from the regulatory framework perspective, AIFs are categorized into three groups. Category 1 AIFs, which essentially include SME funds, venture cap and infrastructure funds. Category 2 is a broad category. The bulk of AIFs are actually registered under Category 2. It includes all kinds of funds, including, of course, real estate and private equity funds as well. Now, Category 3 funds include hedge funds and all those funds that are employing sophisticated strategies to trade in securities, including derivatives. Now, there are over 280 registered AIFs as of the latest data available with the market regulator. And as of December 31st, 2016, these funds have collectively raised a little over 33,000 crore rupees. So that's just the basic setup and some hygiene facts on the way the AIF market is shaping up here in India. So, Mr. Pai, let me start with you first, and let's talk about, the basic intention. It's been, I think, 2012 when these guidelines were put in place. How do you rate the current crop of funds which are out there and the objectives for which the entire framework was put in?
Well, I would say that the regulations put out by SEBI are pretty good, and it's had a very encouraging response. More and more funds are coming in. And I would say the taxation regime needs to be improved. There are too many open questions which have not been answered. For very many years, India has been exporting her investment business overseas. To give you an idea of the implications, the funds invested in the capital markets is over $400 billion. At 2% of fees, there should be $8 billion, 1.5%, $6 billion. I don't think more than 5% of it is managed in India. The fund managers are not in India. The cost of the fund are not borne in India, and the income net surplus is not taxed in India. So we exported out an entire market. Out of the $100 billion of PE funds and other funds that have come in over the last 10 years, hardly maybe 10-15 billion are managed out of India, and that has not created industry. So AIF was started primarily to create a AIF industry in India, and the regulations are pretty good. So between the regulations for fund which could be domiciled outside and funds domiciled in India under SEBI, I think the regulations are almost similar and is working very well. But taxation is a whole different ball game. For example, in AIF 1 and 2, the income that this AIF get to interest or to dividend or to capital gains are passed on to investors after a withholding tax. And in case they do something else called business income, then it will be taxed at 30%. But the business income is not defined, and we don't know what this business income is, giving the officer much discretion because, investment AIFs are passive vehicles. They're not active vehicles. They don't manage a business. So you could have any interpretation. And we have a problem in AIF 3-2 because that's an alternate investment strategy vehicle which is very diverse. They too, the entire income is taxed at the AIF itself, and we don't have many AIF 3 vehicles registered in India because we've driven the business out. So we are very concerned about the lack of clarity about the unnecessary taxation, and we feel all three categories should be treated like the mutual funds in India, where the income is taxed in the hands of the investor and not in the hands of the funds. And the bigger issue is these funds pay 1.5–2% fees. Now, are the fees to be taken as expenses of the fund? Are the fees to be passed on to all the investors every year to be taken as a deduction from their income? Because these are pass-through vehicles. We have no clarity on that. So I think it's a very big issue.
So let me bring in the taxation expert on the panel as well. Gautam, come in on this, and let's take it step by step because there are three different categories. Category 1 and Category 2, as Mr. Pai was also saying, I believe there is a pass-through, right? So it's the end investor that has to pay tax, though there is also an element of withholding tax. But what is really important is this concept of active versus passive. What sort of a fund are you? Are you taking active interest in strategic decisions of that company? If you're an angel fund, do you have a board seat? Are you actually participating in the decisions or not? That, I guess, defines who you are. Does taxation change whether you're an active fund or a passive fund then?
Yeah, and let me just split my comments under two parts. For AIF category 1 and 2, to be fair, the government has come about with circulars and clarifications. One, on the status of taxation, which is the pass-through status, but secondly also saying that for AIF category 1 and 2, your income is most likely to be treated as capital gains, right?
So you get the benefits of the capital gains regime.
You get the benefits of the capital, you're most likely getting the benefits of the capital gains regime. There is a certainty about how the tax is to be collected and levied. There are small aspects, as Mr. Pai pointed out, about, does expenses get deducted or not? Let's just park that aside. I think the challenge is more on the AIF category 3, and tax laws are evolving. While the tax authorities have given a fair degree of certainty and clarity on 1 and 2, I think the markets and have now evolved to a situation where one could look at extending this kind of pass-through benefit even for category 3s, right? And the issue really is, if you and I as an investor were to invest in the listed market space, there is a 2016 February circular which says if I hold the securities for more than 12 months, it is capital gains, and therefore 0 or 15%. But if the same investment were to be done through a category 3 fund, right, I'm not sure, because the tax rate could be as high as 30% for exactly the same income.
So let's actually get in someone who's associated very closely with category 3, and let me get in Nandini into the conversation as well. Nandini, tax, how big is it an impediment? Nandita, sorry. How big is it an impediment when you're talking about setting up, a hedge fund which is using these complicated strategies, long-short funds, etc., under category 3?
So it's the number one issue, I think, and I believe that it has actually stunted the growth of this industry in India. And I think it's the result is that we have a lot of misunderstanding about what the role of AIF category really is for investors in India and for capital markets. So let me lay that out for you. So what does this category 3 mean? It means investment funds which may be long only equity. It may be investment funds which may be long short, market neutral. And what these funds are trying to do is they're trying to professionally manage and bring in some niche strategies which help the investor diversify. Okay, so this diversification is a very important tool, as we all know, in investments and over the life of your investment cycle. So this is the role that AIFs are trying to play. Now, in an economy that is growing like India, where capital markets have actually have evolved over this period of time, this growth capital, and especially tapping the growth capital domestically from domestic investors, is key in bringing down cost of capital. So I'll give you an example. China's cost of capital, you would be surprised to note, is in the mid-single digits, whereas India's cost of capital is in the 14–15% range.
Sure.
And I'm talking equity capital, right? So India's risk premium is certainly high. Now, how do we bring it down? We tap into domestic pool of capital. And this is something that has been done in other parts of the world. For example, in China. China has a $1.6 trillion hedge fund industry. Okay, that includes PE funds, of course. But they have seen the light, and they've done very simple taxation policies. Whereas here in India, we're really battling. And so AIF category 3, as far as I'm concerned, is a non-starter here, because it really puts these funds at a disadvantage vis-a-vis individual investing, vis-a-vis PMSs, vis-a-vis mutual funds. And so what we're really saying is, don't discriminate based on investment vehicle. It should be a level playing field. If mutual funds are being taxed at a certain rate, and we're all paying STT on transactions, regardless of gains or losses, then there's adequate amount of revenue to be generated for the government, and there are real benefits from an economic standpoint.
Well, I guess the crux of this sort of argument or debate is whether the investment income being generated by a category 3 fund, a hedge fund, whether that is really business income or whether that should be simply treated as capital gains. The government has a point of view. The investment community has a point of view. The debate continues after the short break.